Hi, good evening, everyone. Thank you so much for joining me and Chris on this Wednesday evening for a session on global macro strategies. Chris is an expert on alternative strategies, and I'm excited to be co-hosting this session with him and learning more about global macro from him. The next few slides that you're going to see are disclosures and disclaimers from Endowus and Wellington Management. Many in our audience today, and we have clients from Hong Kong and Singapore dialing in, should be familiar with Endowus, but for those who are not, I'll just spend a minute or two on the intro. Endowus is a digital wealth advisor for everyone. You know, whether you're starting out on your investing journey, or whether maybe you have a PhD in finance and you already have spent decades investing, we can help you and we can help make it better. We have a whole suite of investment options to help you get started, and a team of client advisors and cutting edge technology to help you determine investments that are right for you. We are also fee-based, which means that we charge our clients a flat fee based on their assets under advisory with us. We don't do sales charges. We don't accept trailer fees or distribution fees. What we do is we work with our fund managers like Wellington, for example, to get our clients access to institutional share classes. So institutional share classes are share classes that are usually available to just institutional investors or endowments, foundations, and they don't include trailer fees. Where we can, we try to get access to those for our clients, but if we can't, what we do is we give you back 100% of all the trailer fees that we get. So this means that there is really no conflict of interest. We don't push you to the costliest products with the highest trailer fee just to make more money for ourselves. Instead, we try to advise you to pick the right products based on your risk tolerance level and your goals. We are backed by some of the largest investors in the world, including SoftBank, Lightspeed, and other notable names such as UBS, Singtel, Samsung, etc. So they believe in us, and I hope that you believe in us as well. A part of our mission, as you can see here on this very busy slide, is to empower our clients to be better investors and arm them with more knowledge. As such, we produce a lot of content to help inform on the principles of investing, and today's webinar is just one example. We want to keep this session as useful and interactive as possible, so please send in all the questions you have on global macro investing, and I'll be sure to direct them to Chris, the expert. Here's the link. You see the link and the password to Slido, so please log in and ask some questions. Now on to global macro. But first, I'd like to introduce our guest speaker today, Chris Perret. Chris is a managing director at Wellington Management, and he's a member of the investment product and fund strategies team. He's responsible for overseeing Wellington managed alternative investment strategies and works primarily with Wellington's macro and credit investment teams, and is responsible for a range of business and investment related activities. Chris, you can't tell from his looks, but also has years of investment experience, having worked at SSGA prior to joining Wellington in 2010. So I'll now pass the mic over to Chris, who will tell you more about himself and Wellington Management.
Well, thank you, Min, and thank you for your very kind words. I always appreciate when people tell me that I look young, and that's always a very nice compliment. I guess I also just want to thank everybody for joining this webcast today. On behalf of everybody that works at Wellington, we certainly appreciate your time and interest in learning more about a category of investing that, frankly, again, we believe will continue to really serve clients and their portfolios well into the future. Let me just tell you a quick couple of facts about Wellington. Many of you may know us. Others may have heard about our firm, and I think there are a couple of key attributes that you may find interesting about our organization. The first thing to highlight is that Wellington is a private partnership. We only do one thing for clients, and that is to invest money on their behalf or on behalf of underlying beneficiaries for a fee. Wellington does not sell research. We do not have any other third-party services, and as a result, again, it creates a very strong alignment in terms of the objectives that we're trying to achieve, again, on behalf of our clients. This private partnership has endured for a number of decades. Again, as you can see on this page, the firm and its history dates all the way back to the early 1900s, when we launched our first, what we call balanced mutual fund. Today, Wellington is, again, a large diversified asset manager. We're running currently about 1.1 trillion in assets on behalf of, as you can see, about over 2,000 clients, serving those clients in over 63 countries around the world. We have 18 offices at present, so are very global in nature. Singapore and also Hong Kong in your specific regions are both very large and established investment centers that have been in operation for a number of years. And today, one of our key areas of focus from a strategic standpoint is the idea that alternatives remain a very important part of client portfolios. And so today, again, we are going to talk about global macro strategies, which I would define as one of the core underlying allocations that a number of institutional and more high net worth or global wealth oriented clients either currently have investments in or are frankly actively looking to make investments in. So with that, that is a quick overview of Wellington. And maybe I'll pause and Min, turn maybe back over to you.
Thank you, Chris. Well, thank you so much. In this next slide, I'll attempt to introduce and explain what global macro investing means to me, and then hand you back over to Chris, who has a much deeper understanding, and he can go into the intricacies of such strategies. So it's a very busy slide again, but global macro is essentially an investment strategy that fund managers or investors use to make use of broad macroeconomic trends and events that affect countries and economies and financial markets worldwide. So it involves a lot of research and analysis and really sophisticated tools to understand and predict the interplay of different factors, ranging from economic indicators to government policies. And so this means that there is a lot of aspects that you need to consider. So you need really sophisticated and well-resourced managers to manage the strategies well. The macroeconomic analysis, that's the part that is difficult to do on your own. So that's why we trust partners like Wellington to dive into the research and conduct all the analysis to understand the overall economic health, the growth prospects, and structural challenges that countries and regions might be facing. So this is a top-down approach as opposed to other strategies and investment funds that you might be more familiar with, which tend to be more bottom-up fundamental research oriented. So really doing a deep dive on companies and then bubbling up to an investment strategies. For global macro, it's top-down. So you start with the analysis of the entire global economy, and then you go down to maybe specific regions and countries, and then finally narrowing down to different subsectors. So there are a few characteristics here. They usually span across, the strategies usually span across different asset classes because fund managers have to utilize different factors and different financial instruments to express their opinions or views on macro events and how they might play out. And because of the unpredictable nature of these events and trends, risk management is also a very important aspect. And these can include from, such position sizing, stop loss orders and hedging strategies to make sure that the fund manager is limiting losses in the case when markets may move against the trends and bets that the fund manager is making. I'm very sure that a lot of you are very familiar with some of these macro events that have occurred, but maybe you haven't really related it to global macro investing. So I'm just going to take some time to explain this one very famous example, which is Mr. George Soros' trade against the British pound in 1992. In the early 1990s, the United Kingdom or the UK was a part of the European exchange rate mechanism, which aims to stabilize exchange rates between the different European countries. And the British pound at that time was pegged to the Deutsche Mark within a very narrow tolerance band. And this was way before the euro. So Mr. George Soros and his team conducted a lot of research and analysis and came to the conclusion that the pound may be overvalued and that the current economic situation in the UK was not sustainable. So they believed that eventually the Bank of England will not be able to maintain the pound's peg to the Deutsche Mark. So what they did, what the team did was really to initiate this short selling strategy. So short selling is when you borrow certain things to sell. So you're not selling things that you already own, you're borrowing and then you're selling. And you're hoping to buy it back at a later time at a much lower price. And that way you'll close out the position and lock in the profit. So what they did was they short sold the pound and with the expectation that they will buy it back at a much lower price. George Soros also made public statements about his opinion on the pound, making kind of a negative sentiment on the currency. So on Black Wednesday, which is September 16, 1992, the UK government tried to raise the rates in order to defend the pound and maintain the peg. But the short selling persisted, that the pound was still sold off, it's still sold off aggressively. So eventually they couldn't defend it anymore, and the UK government had to withdraw from the ERM and let the pound float freely. So this meant that it was no longer pegged to the Deutsche Mark. And so the value of the pound dropped significantly, resulting in losses for those that were invested in the pound or who were holding the pound, and also making a lot of profit for those who were short the pound. So a lot of profit for Mr. Soros and his team. It was estimated that they might have made a profit of $1 billion from this trade. So that's just one example. And on the other right-hand side, you will see a lot more examples. And one of them, very famous, made into a movie, The Big Short. If you've seen the movie, you will know what it's about. But if you want to know more, please feel free to read up on it or look into the examples shown. With that, I'll turn to Chris now to go over the different types of macro investing strategies.
Great, thanks, Min. As Min has highlighted, macro is a very, very diverse and, in some ways what we call, very heterogeneous space, meaning there's a lot of different ways that you can implement a macro idea or strategy within a portfolio. And so, one thing I always like to do is, maybe especially as the world here has evolved and we have access to things like artificial intelligence, is just ask the computer what is macro investing, because I think it's always important to kind of compare what our opinions are to generally, in this case, what a computer may think. And so, as you can see, we asked ChatGPT what is a global macro strategy, and what I read here is actually somewhat, I think, what Min has highlighted is that a macro investment approach trades across a very diverse set of assets, first of all, and really at the end of the day is rooted in research, and importantly research that has a degree of underpinnings of economic fundamentals and understanding. But as I said, right, the thing that's really interesting about macro is that it just can span so many different things in so many different parts of the world. And I think that's what makes it such an elegant type of an approach is that there always is something going on that may or may not be understood by the market, which creates, frankly, inefficiencies that can be taken advantage of. So whether it be, again, back in, I think that was the late 1970s, early 1980s with the British pound and what George Soros was able to do, whether it was as all the other examples that have been highlighted, these are events that frankly sometimes aren't fully understood. And whether it be one individual has one opinion and another has another, that's where those inefficiencies can get created and create some really big opportunities to take advantage of. And I think as we move forward, that's what also gives us a lot of excitement and confidence about this type of strategy. And we'll get into this in a little bit, but the world looks quite uncertain to us from an economic perspective as we move forward. And there's a number of both, let's call it near term and more longer term structural reasons why. And when you get uncertainty, you tend to get a lot of volatility in markets. And macro investing historically has been shown to be a type of investing style that tends to do really well when you get a lot of uncertainty and therefore volatility in markets. So again, we're quite excited about it. If you look at the next page, and again, this was somewhat already highlighted from an opportunity set standpoint, macro investing does really span the really full gamut of what I would define as the public and liquid markets that exist globally. So whether it be fixed income, currencies or foreign exchange markets, equities and commodities, macro oriented strategies typically will invest across this landscape. With that said, though, as we've highlighted here on this page, what we tend to find, both even within our own capabilities at Wellington, but more generally within the industry, is that macro strategies tend to emphasize fixed income and currency markets, and then will dabble, but have certainly a less degree of prominence in their portfolios, either it be from an exposure or risk standpoint to the equity and commodity markets. And one of the reasons for that is that, as has been highlighted, right, is that macro investing really does, is deeply rooted in economic understanding and really trying to find that intersection between what an economy is telling you and what the underlying markets are pricing. And at times those can be disconnected. And that's where you find, again, situations like the British pound being extremely overvalued, because there is that disconnect and that intersection doesn't necessarily align with what you generally are looking for. And the instruments that tend to have a very good relationship with the underlying economic fundamentals tend to be things like fixed income and currency. So, one example in the fixed income markets, as many of you may know, is that a lot of the instruments in fixed income are actually tied to monetary policy. So whether you look, say, at the 2-year interest rate or the 2-year treasury bond in the US, right, that tends to be a very good proxy for near-term expectations of where interest rates are going. And where interest rates are going is typically determined by a central bank. So in this case, the Federal Reserve. And so being able to understand that, and in some cases position for that, or understand whether the Fed is going to be increasing or decreasing interest rates, can be a strategy that actually can take advantage of that economic understanding. Foreign exchange markets, again, a useful tool. And I think where we believe equities and commodities can be useful is this notion of really adding dimensions to a macro strategy and not necessarily being reliant on one style or one asset class to really drive returns. And this kind of gets me to another point is that, for a number of decades, for about a decade, macro investing was a little bit challenged because, markets really were very healthy. There was not a whole lot of volatility. And so therefore, the more kind of traditional mechanisms for taking advantage of macro investing, again, across fixed income currencies was a little bit challenged. So we've found that a lot of really successful macro funds have been able to diversify into other asset classes and really add a lot of different dimensions to what they do. Before I move on to the next slide, though, the last thing I want to highlight is, and I think this was maybe a question, is what are the different ways that you can implement a macro portfolio or investment approach? And as I said, macro is a very heterogeneous style of investing. There's no one right or wrong way of doing it. And as a result, you tend to find a lot of different approaches, whether they are more concentrated, meaning they take really big bets, whether they tend to be more diversified in terms of spreading out their bets to different underlying markets and instruments. whether they're more fundamental or discretionary in nature, whether they're more systematic or quantitative in nature. Those are also very common approaches. And then one that has certainly grown in uniqueness is this idea of running a macro strategy that really aims to embed a lot of specialization within the underlying portfolio, versus the more traditional approach, that a la the George Soros approach, which is having one key individual make all the underlying investment calls within the portfolio. They're again the more kind of single manager, CIO driven approach. Today, what we find is that the more common and interesting way of accessing a macro fund is to really look for funds that are specialized, meaning they have a lot of underlying people and resources, and give those people and resources a lot of independence to go into their little pockets of opportunities, find them, and then have the independence and autonomy to put those ideas or trades into the fund or portfolio in a very unimpeded way. So like many of diversification, right, is one of the really only free lunches in investing, as they say. It's one thing if you can intelligently embed it has a lot of beneficial attributes. And macro funds in a lot of cases have moved to this model of a multi-manager or specialist driven approach, just given the fact, again, that these are very wide and diverse markets. And therefore, if you can spread out your bets to different people that have maybe, frankly, very different views, it can really embed a lot of diversification and smooth out the ride of creating a more consistent positive return profile over time. So we're finding that a lot of the more modern oriented macro approaches tend to utilize this multi-manager or specialist driven approach. On the next page, we highlight here just two simple examples of how a macro strategy can find opportunities. And so maybe this is the other implementation way to think about macro, in that in a lot of cases, what you will find is that a macro strategy will look to trade from a directional standpoint, meaning it will, again, identify the British pound as being overvalued and therefore a short candidate, or the US equity market to be undervalued from a price to book standpoint and therefore an attractive long candidate. Those are more directional type of positions, tend to be very profitable if identified correctly, positioned early, and in some cases have a longer time horizon to them, or in some cases they can have a shorter time horizon, and are very common within a macro fund. So on the left-hand side, you'll see an example that I highlighted here of a trade, again, that many, from our understanding, funds had on, say, last year. And really was the idea that, if you looked at measures of inflation, inflation very, very quickly, you can see in the, let's call it late 2020 and into 2021 and 2022, skyrocketed, right? You can see on the left-hand side of that chart, in terms of the axis, that inflation went from about 0 right after COVID to 9% on the headline basis in the US in a matter of, let's call it 18 months. That was a very profound change. And I think many of us know why that happened. It was a function of supply side constraints, right? As we moved out of COVID, and people wanted to consume, and again, a number of factories and very much just in time kind of delivery manufacturing was really constrained and not able to restart in time. It created a lot of inflation, and that inflation did persist for a long period of time, and the fixed income markets were not prepared for that. Because, right, what was happening was our central banks around the world were telling us that inflation was going to remain fairly low. And so that created a big opportunity to get ahead of that position by going short the fixed income markets here through what we call the 2-year rate, 2 years forward, or again, kind of a proxy for future potential monetary policy and take advantage of that, as Min had highlighted, through a short position, betting that rates are going to go higher, fixed income prices are going to go lower. And so therefore, if we sell those prices today and then buy them back in the future, we can earn a profit in doing so. So that would be one example. The other example, for a typical strategy is to put on a non-directional position where at the end of the day, you're looking to find two assets that tend to be very highly correlated. And as a result, that correlation potentially can break down and create really interesting mean reversion opportunities. And so these types of positions tend to not really have, again, a big directional lean, but really what you're trying to do is find situations where there's mean reversion potential. And one of my favorite ones in fixed income is this position or phenomenon that happened in 2021, where the Austrian fixed income markets, in particular at the very, very, very long end of the bond market there, exhibited a big dislocation that you can see on this page, where the very long end bond market started to price in a big amount of additional yield relative to the 30-year proxy of that bond market or on the curve. And that really doesn't frankly make a whole lot of economic sense, right? Is that at the very, very long end, the 100-year bond, right? It's a very unique instrument. Is if you're a country or any institution and can issue debt out to 100 years, you're likely or have a very, very low probability of defaulting. And in the case of Austria, I think they have a AA, maybe even a AAA credit rating. So very, very low chance of defaulting. Yet what happened here is that you can see is that all of a sudden, the very long end, the market starts pricing in that maybe there's a little bit more risk to that happening. And economically, from our perspective, that didn't really make a whole lot of sense. And so it created this really unique opportunity to put on what we call a curve flattener position, betting that the long end, the ultra long end, the 100-year bond was dislocated and therefore was going to exhibit some degree of mean reversion relative to the more kind of traditional part of a bond market, the 30-year instrument. So those are two fixed income examples. Again, there are countless other examples I can highlight, and I think that's what makes macro so fascinating and such a unique type of strategy is that if you can find people or managers that have expertise in doing this, it can be a very profitable type of strategy to add to the portfolio. And lastly, as we're going to talk about, I think next, provide a number of unique benefits when you think about it from a holistic portfolio perspective.
Thank you, Chris. I actually have a number of questions just based on what you said. It's really interesting. You mentioned that you've started to see a trend towards more multi-strategies within the global macro space. So instead of just having more directional, it could be, would you say that that means that there's going to be more non-directional strategies versus directional? And that means that there is less risk involved with the non-directional strategies?
Yeah, it's a really good question. So maybe just I'll expand upon what I was saying a little bit earlier is that I think, so if you look at the time period from, let's call it 2012 to 2016, 2017, maybe even a little bit later, the world was a very, it was a very unique part of time, right? Where we had just come out of, two big crises, the first being the global financial crisis. And then right after that, many of you will remember, and I saw you highlighted on that page earlier, we also exhibited the kind of the second order effects in Europe of the European sovereign debt crisis. So those were two really, really big shocks. And it forced policymakers, i.e. central banks, to put on monetary policy that was very accommodative. And that degree of accommodation really changed the way that markets behaved in frankly very non-fundamental ways. And the result is that you could just simply invest in ultimately what happened, right, is that policy went to very accommodative. and it created a very one-dimensional market, meaning all you really had to do was buy bonds and stocks and kind of sit on a very passively oriented portfolio and do very well. And again, I think a lot of us did that, and it was a very profitable way of investing. What was very non-existent during that time was volatility. And as a result, as I said at the beginning, when you don't have a whole lot of volatility, it tends to be somewhat of a challenging way of investing from a more active perspective. And macro investing is a very active style, tends to trade a lot, tends to exhibit a lot of turnover. And when you don't have movements in markets, it can be somewhat of a challenging environment. And so the more directionally oriented macro type of strategies did struggle during that time period. And so what we found is that a lot of macro funds or macro managers have learned from the lessons of that time period, and learned that one of the ways to really ensure that at the end of the day we're in the business of delivering compelling performance for our investors. One of the ways to really ensure that that can remain the case is to add dimensions, right? Add different types of strategies that may be a little bit less reliant, say, on a specific underlying market environment. So that when you go through a full cycle, whether it be we go back to the period of, again, 2012 to 2017, where all you had to do was invest in the equity markets, we want to have a subset of the strategies that can do well in that environment. And equally, like the environment we seem to be in right now, where there's actually a lot of volatility, we also want to have a set of strategies that can do well in that type of environment. So this kind of notion of finding a multi-strategy oriented macro approach does have its merits. And that's what we are finding is that, yes, finding strategies that have macro underpinning. So in the example I gave of the Austrian bond market, fundamentally is totally sound, right? From a credit quality perspective, Austria is not on our radar as a country that we think is all of a sudden going to spiral into default. And so when that bond market starts to exhibit a dislocation, if it economically doesn't make sense, and we can put on a very elegant position that doesn't really expose us to the underlying direction of the Austrian market or the Austrian interest rate market, that can have benefits, right? And in a lot of ways, tends to be uncorrelated to what's happening from a more directional standpoint. So yes, we are finding a lot of macro strategies move into this direction of being somewhat multi-strategy and multi-dimensional across, whether it be asset class, right? So trading across all those asset class that I've defined, whether it be stylistic, so as I said, some macro funds have both systematic and discretionary strategies in them. And then also, again, trying to find different styles of investing within that has proven to be a recipe for success.
Thank you, Chris. That was very insightful. Actually, related to that, there is a question on Slido. This person asked, prior to last year's strong performance, macro funds have had a very bad decade.
Yeah.
Do you expect the performance to improve considering a change in regime? We're going back to the old normal versus the new normal. So
it's a great question. Yeah, so I think the answer kind of has two parts to it. The first is that from our perspective, we certainly do believe that the old regime is back again, meaning the era of elevated economic uncertainty is a phenomenon that we don't think is going away. And so if you assume that there's more economic uncertainty, that likely means there's going to be more volatility in markets as we move forward. So we put a slide together on that. I think it's on page 22 that kind of outlines this from our perspective. And what we do here is, maybe it's the next slide. There you go. Yeah. What we do here is just simply take the measure again of inflation and create a measure of actually inflation volatility, right? Or what is the standard deviation of a rolling 12-month measure of US headline inflation? And as you can see, again, from about 2011, 2012, as I said, from all the way to 2018, 2019, inflation was low, right? And so there was really not a whole lot of economic volatility around that specific measure. That clearly has changed, and we think there are a number of reasons why, in this case, inflation uncertainty is likely to remain elevated, for reasons like demographics. Right, demographics are changing around the world, in a number of different parts of the world, and those demographic changes are going to create changes in productivity. And that's going to have a big implication on the world. The other one that, the other kind of D out there, right, is deglobalization, right? That is a phenomenon that, at least, over the next, let's call it decade or so, does not seem to be going back the other way, back to a more globalized world. And so those are going to have big implications. I mentioned a little bit ago that, if we truly are in a world of deglobalization, then just-in-time manufacturing may not necessarily be currently set up to be successful. And so, that's going to have implications from an economic perspective, and in particular, things like inflation. So we assume inflation, at the very least, is going to remain more volatile and more cyclical. That likely means we're going to have to go through more real cycles, right? So if you think about a cycle on the dimension, say, of growth and inflation, right now, we're in a period of decelerating growth and decelerating inflation, and that likely at some point will bottom, right? And that will require central banks to adjust policy from right now, which is somewhat tight, right, and not very accommodative, to more accommodative, and that's going to create a big trend, and therefore a lot of opportunities. So we do think we're going to go through these more profound, or more prolonged, I guess, cycles, and that's going to create a lot of opportunities along the way across all four of the quadrants that would make up, again, the dimensions of growth and inflation. So there's that element. The other thing that I want to emphasize, though, is that if we do somewhat end up back in a period of more, let's call it homogeneous markets, where, again, whether it be equity markets are on a big bull run, whether it be the fixed income markets are on a bear run, that will still create opportunities. And as I mentioned, as macro funds really have modernized to be more multi-strategy in nature, we think it will create a lot of opportunities as well, and really not necessarily subject us to the pain that was the case for about a decade, has been highlighted here. So we're quite positive on this space, both from an alpha opportunity set standpoint, but also from the added benefit that macro funds provide investors, which is, I think we're going to talk about next, is this element of diversification, right? Which, in an environment of uncertainty, is a really important attribute that we think in a lot of cases clients are underexposed to and need to actively consider.
Thank you, Chris. That was great. That was really helpful. So
Sure.
Let me just go back to some of the slides. Well, now we've gone over the different types of strategies. And this slide really just kind of summarizes what Chris had talked about, the advantages of investing in global macro strategies, diversification. If you have strong views, you may want to pick a manager that has similar views and capitalize on some of these trends. There is, of course, potential for a huge alpha generation, but that comes with also high risk. And as you can see from the chart on the right, I think Chris has already mentioned that there are different types of strategies with very different performance profile, risk return profile, and performances just over the years. So this is really just, taking from 2000 to 2018, but yeah, it's still very valid today. Well, and
yeah, I think last year was sorry, Min, just to to highlight that, last year was probably, I think as one of the questions or comments was made is that, last year was a really good year for macro funds, but even within that good year, there was a lot of performance disparity. And I think that really comes down to, again, the style, the implementation of the macro fund that you're looking at. And that, again, it's a very different space. And so, I saw numbers of some macro funds up in some of these ranges that I see in 2008, where they were up 50+%. And then some, there was a big cohort that was more in the, as you can see in the 95th percentile, up about 20%. So it does range a lot. I think where we found that really what a client is looking for is that consistent all-weather type of positive return outcome, with, importantly, this very clear focus on preserving on the downside, meaning not subjecting our investors and their capital to big losses. And so that is, that's tricky. It's hard to do that, but that, the high flyers that can make 50+%, what we found is that tends to not be one, repeatable. It's very hard to do that for multiple years. And two, difficult for clients to be able to stomach the other side of that, right? Is that it's equally plausible that you could lose 50+%, and is not really what many are interested in. So when you take those numbers and kind of distill them into what ultimately is, we think, repeatable and achievable, it's more in the high single, low double digits from a net return standpoint, with drawdowns that can be of similar size, but of less frequency, I think, is kind of where ultimately the sweet spot lies.
Thank you, Chris.
Sure.
So I'm going to hand it over to you for the next few slides.
Sure. Yeah. So, again, I think why are we here? Why is this such an interesting space for investors like yourselves to consider? And I think we've touched upon this. Is macro strategies in a lot of ways are one of the unique categories that does provide kind of two, again, if you identify the right manager, two really attractive benefits. So the first one, again, somewhat obvious, but the ability to deliver alpha is, from our perspective, possible. And that alpha, again, also has the notion that if you find the right manager, repeatable. In that the macro style really does aim to capitalize on inefficiencies, right? I think what we're suggesting is that the public markets in specific pockets can be at times or persistently inefficient, and skilled managers therefore can extract the alpha that is available in these markets. And so that is the first thing. But obviously, in a world where returns are extremely important, or the ability to deliver some degree of outperformance relative to the market is really important. Again, macro strategies can be a useful tool for that. I think the other thing, though, that is equally important in this environment is being able to find a strategy that can offset the effects of your traditional asset performance, right? So at the end of the day, we all have exposure to the underlying markets. That's just simply a function of investing, right? Having a portfolio full of equities and bonds and other traditional assets, there is a high degree of correlation between how your portfolio is going to perform and how the underlying markets are going to perform. And so, in a year like last year, and I think we have a slide on this, that traditional portfolio mix, say of 60% bonds, or 60% stock, excuse me, and 40% in fixed income, did experience a fairly material degree of underperformance, which we highlight on that right chart there. Again, what we're just doing is showing you the calendar years of a traditional 60-40 portfolio, I think US equities and US fixed income. And over the last, call it 4 or 5 decades, I think this was the second highest negative calendar return on record. So it tends not to happen all that often. But again, I think from our perspective, it could happen more often. And the reason for that is this kind of notion of potentially us moving into a different regime where, as you can see on the left chart, there were a number of years where both fixed income and equity markets were equally challenged. And if we were to go back into a world like that, where repeatable, consistent, positive performance from more traditional assets would be called into question, finding strategies that really are not beholden or don't really require an uptrend in the more traditional asset classes can be really valuable. And that's what essentially macro provides, is that again, macro is designed to be an uncorrelated source of return. And embedded in that is typically when macro strategies do well, is typically when you find other more traditional assets to be called into question or compromised, like last year. So again, I know somebody had highlighted last year was a really good year for macro. It was. And again, it provided tremendous offset, right, to what happened, which was, a 60-40 portfolio was down almost 20%. Like that really, I think, hurt. But if you had a macro strategy to help offset some of that had a big important element of diversification. So, we find macro to be one of the few investment categories that does provide this kind of diversification benefit. And so therefore, considering it as part of your portfolio, not in a huge way, but as a satellite type of strategy to add to your more traditional assets can be really useful.
Thank you, Chris. I definitely agree with you there. I think we've already touched on this slide, so maybe just going to move on quickly. Actually, just kind of compounding what Chris has already talked about. This is really a case study where we have 4 different portfolios. One, the 60-40. This time it's using the ACWI and the global ag, and 3 portfolios with varying allocations to global macro, which is represented by HFRI macro index. So this is an index of, I believe, equal weights of different macro strategies. So it's really just the average performance of the average global macro fund within the index. And I don't know that it's typical, it's representative of all the global macro strategies out there. We've already seen that it's a heterogeneous universe. So yeah, but when you add some allocations to it, you can see that the drawdown can be better controlled. So really, this chart is difficult to read, but it's just to illustrate two points. One is that diversification really helps, whether it's adding fixed income or global macro, because you see that the light blue line is actually the S&P 500, which has the largest drawdown versus the other portfolios. The green line is the 60-40, 60% equity, 40% fixed income, and that actually did better than the 100% equity portfolio in drawdowns. And the dark blue line is the portfolio with 40% equity, 40% fixed income, and 20% global macro. So this is not to say that we all should go out and put 20% allocation to global macro strategies, but it's really just to illustrate that it can really help with diversification. And then again, looking at these 4 portfolios with the 4 different circles and looking over the different periods, you can see that from the 3, 5, and 10-year periods, the gray dot, which is the, I want to say 55% equity, 40% fixed income, and 5% global macro, that actually has the best risk return profile out of all 4. But when you look at the 20-year period, that changes too. So 60-40 has done. So this is really just to say, we should, whenever we want to invest in something, please look at your time horizon, what kind of investment horizon you have, your risk tolerance, what return, what risk profile you want, and so as to decide what kind of allocations you want to different asset classes. So with that, I'll turn it back over to Chris to close out with the ideal environment for global macro strategies.
Yeah, thanks, Min. So the punchline here is that as we've talked about, in periods of uncertainty, what happens? In periods of whether it be economic or financial market uncertainty, volatility tends to go up because investors, for various different reasons, can either panic or can get greedy, and that creates a lot of movement again amongst the markets. And so you can easily measure that through a measure like the VIX index, which essentially takes the implied volatilities of a number of underlying equity securities and measures it over an annualized basis. And there will be times, and this has happened over again multiple decades, where volatility tends to go up and stay elevated for quite a long period of time. And as I think I've articulated, we think we're back in a regime or world where volatility is going to remain elevated. There are a number of different reasons why we think that's the case. And a lot of it really comes down to a world that does look fairly uncertain to us as we move out. We've got the US debt ceiling here in the next couple of weeks that's may or may not get resolved. We're rapidly going to be approaching a US election cycle. We've got a number of economies around the world that are still suffering from elevated inflation. We've got more structural trends that again, frankly, suggest that the policies of the past decade or so are likely not going to be able to be replicated. And so that all to us suggests more uncertainty. And when we get more uncertainty, we get more volatility. And that tends to be a very opportunity-rich environment for a macro fund or a macro strategy. And as you can see here, we have charted that, where what we're doing here is taking the VIX index and overlaying the 1-year rolling returns of the HFRI macro index, so the index that Min has used to highlight how it can be beneficial when added to a 60-40 portfolio. And as you can see here, when volatility tends to tick up, macro types of strategies tend to do really well. And that is a unique characteristic that you tend not to find amongst either other alternative styles of investing. And certainly the case, not a characteristic that you tend to find from traditional assets. And so, again, what does that mean? If we go back to that slide at the beginning, or back on to say page 20, to us that means you're going to have a lot of return potential or a lot of alpha potential to make money, and then secondly is it can be a really useful diversification tool within an aggregate portfolio. And again, I think we've highlighted how that actually can really benefit a total portfolio, especially in times of market stress. To close things out, if we just maybe also then think about what are the key risks to consider within a macro portfolio. I always like to remind clients that this is not easy. We're talking about a very sophisticated style or approach that has a lot of different ways that it can be implemented. We've talked about that from all the different approaches and styles, and then frankly, then returns that can be generated and risks that are associated with these types of strategies. And so, again, what you're buying and making an investment in when you identify a macro strategies, what you're essentially trading off, right, is market-led returns from active-led returns. And so you're trading off perceived market performance from active manager to active manager skill. And underwriting or analyzing or researching investment skill does require, really, we think, deep assessment of, what you're ultimately getting invested in. So understanding a manager, the strategy's underlying concentration to markets is really important. Secondly, understanding how they use leverage can be a really important thing to understand. Illiquidity can be factored in making sure that you understand that in terms of the underlying strategy is really important. Understanding how a strategy will perform and be adaptable to different regime shifts is also really important. And all this comes down to, at the end of the day, that the thing that I always stress is that simply relying on past performance is not, frankly, we think, enough when making an investment in an underlying manager. Is you have to really do the work from the bottom up to understand what their process is before you make an investment in a macro strategy. Because, as I think has been highlighted, that there can be years that a macro strategy may struggle, and understanding why that is, ultimately how that relates back to their process and how they manage risks is really important. So that's not to say that, again, we don't think there's a lot of really good managers out there. There are, but really understanding why they do what they do, and not necessarily relying on their past performance is really important, because this is, again, an active strategy that really is all built on proven investment skill, not necessarily a perceived market opportunity. So lastly, I'll just close with a great quote from an also legendary, macro manager, Paul Tudor Jones. Again, he's the CIO of a very well-known and established macro firm called Tudor Investment Corp. He was on CNBC earlier or late last year, and I love the quote, right? These are spectacular times for macro, and great times for macro are typically not good times for general investment or owning stocks and bonds. Macro works when everything is broken, and that's when you have the most volatility, and it's the best time for trading the way that I do. So again, I think that in a lot of ways encompasses what we talked about today. I hope you've gotten some out of today's presentation. And maybe with that, Min, I'll turn it back over to you and see if there's any final questions.
Thank you, Chris. I love that quote. That's a great quote. Actually, we have a ton of questions.
Summarizes everything we've talked about.
Exactly. We do have a lot of questions, but I don't think we have enough time. So how about we just go through maybe one or two? The first one, the one that's been uploaded the most, is considering how increasingly interconnected global markets are, how do you manage potential spillover effect?
Yeah, that's a really good question. Markets are extremely interconnected today, and you see that both in terms of the price action, where one event, say in the US, will have immediate spillover effects in the European markets, and then likely the next trading session in Asia. And so the way to best manage that is, frankly, to be global, right? Is to operate a macro fund from a global perspective, we think is critical. If you look at any of the well-established outfits, including our own platform, we operate 24/7 in terms of a 24/5 trading operation, and that we have investment teams that are located around the world geographically, so as to be able to take advantage of this interconnectedness and make sure that we always have our pulse on what's happening and can react accordingly. The other thing I think you have to do is, I've emphasized this at the beginning, we haven't touched a ton upon it, is this idea of equally emphasizing ongoing macroeconomic research alongside of trading. And so, what we tend to find is that you really have to staff a macro portfolio with equally good portfolio managers and economists. And where we found the most success is to have those two different functions work together, but equally be independent and specialized. And so an example would be, say, again, back to what's happening in the US here with the debt ceiling, is we have a macroeconomist that is focused entirely right now on the US debt ceiling and how that may or may not transpire. And to then communicate that information across our different portfolio teams. So then they can evaluate how that is relating to the underlying markets or opportunity set that they focus on, and invest accordingly. And so, research is so critical in these interconnected markets today.
Thank you, Chris. We're a little bit over the hour, so I'm so sorry, but we won't be able to have time to go through all the other questions. But we'll try to, if you can just maybe connect with one of our client advisors, we'll try to get the answers to you. Thank you so much, Chris, for spending your morning with us. I know you had to get up really early, so we really appreciate it. Thank you so much. Thanks everyone too.
It's my pleasure. Yes, absolutely. Thank you so much.